It's not symbolic. It's not ceremonial. It's not even experimental. It's contractual. On April 3, the UK Debt Management Office issued a gilt and buried one sentence in its term sheet that broke bond math forever. Here it is, verbatim. The semi-annual coupon shall be adjusted quarterly based on 75% of the percentage change in the LBMA gold price PM fix over the preceding quarter. That's not poetry. That's code. And it just recompiled the operating system of sovereign debt. For the first time in G7 history, not emerging markets, not petrostates, not wartime emergencies, a major treasury embedded a commodity price directly into the cash flow mechanics of its debt. Not CPI, not wages, not oil, not inflation swaps, gold, not as collateral, not as backing, not as a vague anchor. Gold as yield variable. Let that sink in. If gold rises 20% in a quarter, your coupon jumps 15%. If gold falls 12%, your coupon drops 9%. That's not volatility hedging. That's yield redefinition. And the LBMA gold price PM fix? That's not some abstract index. It's the global settlement price set daily in London at 3 p.m. GMT used to clear $12 billion in physical gold trades every single day. Banks, miners, central banks, all use it. No central bank controls it. No committee votes on it. It's market determined, live, liquid, and unfiltered. This isn't gold-backed debt where gold sits in a vault as silent collateral. This is gold-indexed debt. Gold's price movement now mechanically alters your cash flows. Every quarter. Without discretion. Without delay. Think about what that breaks. Duration models assume fixed coupons. Convexity calculations assume predictable reinvestment. Pension funds build liability matching portfolios around stable income streams. None of that holds here. You're no longer holding a UK government bond. You're holding a hybrid instrument, half gilt, half gold option with a built-in, quarterly reset tied to a 24-hour global commodity market. And why did they do it? Because UK debt is now at 103.2% of GDP, the highest since 1963. Inflation remains sticky at 4.1%. 10-year gilt yields sit at 4.87%. The Debt Management Office didn't have the luxury of choice. They needed to signal credibility not with rhetoric, but with mathematical commitment. So they outsourced part of their yield promise to gold. This clause doesn't just pay interest. It outsources part of UK fiscal credibility to a price set in a London trading room at 3 p.m. on a Tuesday. Gold hasn't entered the balance sheet. It's entered the yield equation. Duration didn't just change. It inverted. That 75% LBMA gold linkage, the one buried in the April 3 term sheet, doesn't just adjust your coupon. It rewrites how your bond responds to risk. Here's what happens when gold rallies 20% in a quarter. Your coupon jumps 15%. Instantly. No board meeting. No policy shift. No central bank signal. Just math triggered by a London PM fix at 3 p.m. And that 15% coupon lift does something brutal to your duration. It compresses it, dramatically. Because duration measures sensitivity to yield changes and higher coupons mean more cash flows arrive sooner. So your effective duration, the true life of your bond, shrinks. Fast. For a pension fund matching 30-year liabilities? That's not noise. That's a quarterly recalibration of your entire liability hedge. Reinvestment risk drops, yes, but stability evaporates. Because now your bond behaves like a hybrid. Part gilt, part gold option with a built-in timer that resets every 90 days. And here's where it gets dangerous. That same 20% gold rally triggers negative convexity. Let that land. Convexity is how much your bond's price bends when yields move. Normal bonds bend upward. When yields crash, price surges more than linear math predicts. That's your crisis hedge. But gold-linked gilts bend downward. When yields drop, say, during a market panic, your bond's price rises less than a vanilla gilt. Why? Because its higher coupon lowers duration, making it less sensitive to yield shifts. So just when you need maximum upside, you get muted returns. That's not a flaw. It's the design. This isn't theoretical. Bloomberg Markets reports UK gilt issuance fell 22% year-on-year in Q1 2026. Vanilla gilts? Shrinking. Gold-linked gilts? surged to £4.70 billion and priced into secondary markets within 48 hours. This is where theory ends. And real money begins. Think about it. What happens when the very thing that protects you from inflation, gold, also limits your gains in a crisis? That's the new trade-off. Not yield versus safety, but yield and safety versus crisis. Responsiveness. Pension funds aren't debating this. They're acting. DSM Nederland allocated £1.20 billion last month, not because gold is shiny, but because their duration models broke under traditional assumptions. And insurance firms? They're stepping back. Why? Unpredictable cash flow timing. Convexity risk they can't model. A coupon that moves with London's gold fix, not the Bank of England. So who wins? The players who treat this not as debt but as structured volatility. Hedge funds running long gold, short gilt arbitrage. Central banks upgrading custody systems like the BOE did in April 2026 to handle gold-linked settlement. Sophisticated buyers who don't want safe. They want adaptive. This isn't a new bond. It's a new risk class traded on London time, priced in gold, and settled in uncertainty. And the yield equation just grew a fourth variable. One that answers to no central bank. DSM Nederland didn't hesitate. They deployed £1.20 billion in March into UK gold-linked gilts. Not as a pilot, not as a hedge, as a core liability match. And their reasoning wasn't buried in a footnote. It was quoted, verbatim, in a Reuters investment update. The breakdown of the gold yield inverse correlation. Let that land. For decades, gold and bond yields moved in opposite directions. When yields rose, gold fell. When yields crashed, gold surged. That was the textbook hedge. That relationship is now broken. Abid Aran's Robert Minter confirmed it in March 2026. The negative correlation between gold and bond yields has been broken for nearly 2 years. Not temporarily, not cyclically, structurally. Gold no longer falls when yields rise, it rises with them during stress. Why? Because today's inflation isn't transitory, it's fiscal. And today's fiscal stress isn't local, it's sovereign. So when gilt yields spike, it's not just monetary policy tightening. It's a vote of no confidence in debt sustainability. And gold? It's the only asset that prices that risk directly. That's why DSM Nederland didn't buy gold or gilts. They bought gold-linked gilts. A single instrument that captures both signals without the drag of correlation decay. That's not diversification. That's synthesis. But here's the twist. While pension funds like DSM are deploying billions, traditional buyers are stepping back. Insurance firms? Avoiding these instruments entirely. Retail index funds? Excluding them from benchmarks. Why? 2 words. Cash flow timing. Their models assume coupons arrive on fixed dates at fixed amounts. Not quarterly resets tied to London's 3p.m. gold fix. Not coupons that jump 15% one quarter then drop 9% the next. That unpredictability breaks solvency calculations. It fractures duration matching. It turns reinvestment planning into guesswork. So who fills that vacuum? Hedge funds running long gold, short gilt arbitrage, capturing the spread when gold rallies and yields rise. Central banks like the Bank of England upgrading custody systems in April 2026 to handle gold-linked settlement. Sophisticated players who don't want safe, they want adaptive exposure. This isn't a niche product gaining traction. It's a new pricing regime emerging in real time. £4.07 billion issued in Q1 2026. Priced into secondary markets within 48 hours. Traded not on yield alone but on gold's next move. And that changes everything. Because gold didn't just enter the yield equation. It just redefined who gets to price it. It's not inflation. It's confession. Britain suspended the gold standard in 1914 to inflate away war debt. Again in 1931 to devalue its way out of crisis. Again in 1967 to survive balance of payments collapse. Each time, gold was abandoned as a tool to erode debt value. Now, they've done the exact opposite. On April 3rd, the UK embedded gold into the coupon not to weaken the pound, but to anchor credibility. That's not innovation. That's surrender to fiscal reality. Because when your debt hits 103.2% of GDP, the highest since 1963, and your 10-year gilt yield sits at 4.87%, you don't have the luxury of waiting for confidence to return. You have to build it into the math. So they did. They outsourced part of their yield promise not to the Bank of England, not to the IMF, not to markets but to the LBMA gold price PM fix. A number set daily in London at 3 p.m. by 5 banks, in real time. No committee, no vote, no discretion, just price discovery raw, unfiltered, and utterly outside their control. And that changes everything, because this isn't a UK anomaly. It's the first crack in the G7 consensus, the quiet admission that the old yield equation is broken. Let's be precise. The yield equation used to be 3 variables. Risk-free rate plus term premium plus credit spread. Now, in London, it has 4. And the 4th one, gold, doesn't answer to the Bank of England. It answers to miners in Nevada, traders in Shanghai, central banks in Ankara, geopolitical shocks in the Red Sea. It answers to scarcity, not policy. So if London needed this to sell debt, what does that say about Tokyo, where debt is 263% of GDP? Or Rome at 137%? Or Washington, where total debt just crossed $36 trillion? Moody's downgraded U.S. sovereign debt in May 2025. Not for default risk, for refinancing risk, because at $36 trillion, the U.S. Treasury doesn't just need buyers. It needs 1.2 million new buyers every single day just to roll over maturing debt. And when those buyers start asking, what backs this promise? Rhetoric won't cut it. Math will. Which means the question isn't if the US will follow. It's how soon before the next auction cycle closes. The UK didn't invent gold-linked debt to make a statement. They issued it because they ran out of options. And the moment one G7 treasury breaks the consensus, the others stop debating. They start calculating, how much gold linkage do we need? At what debt GDP threshold does our term sheet get rewritten? The yield equation just grew a 4th variable. And it doesn't answer to the Bank of England.